You could not, you would have a very difficult time today getting a venture capitalist to invest in a hardware company, right? And by that I mean a consumer hardware company. We just realized the margin compression there, the copycatting, it's just incredibly difficult. Distribution. What's fascinating to me about Apple is the fact that they've been able to do what they've done on the backs of things like the iPod, now 9 years old, the iPod, obviously iTunes, the iPad, the iPhone. These are not businesses that VCs are going to invest in. And in some ways that probably helps them, because the only people they have to worry about are big established companies who tended to be very slow. Another company near and dear to my heart, Green Dot. Some of you know what they do, the prepaid debit card for what they call the unbanked. There's another company I think is, like Netflix, really, really highly priced right now. If you look at the numbers today, they're trading at about a $650 per member per card valuation. Now think about that. So 650 bucks, when they make about $10 a month per card member, and the average card member lasts about 12 months. And so that doesn't make any sense to me unless you assume they're going to get really, really big. But on that, NetSpend, their chief competitor, just went public and is trading about the same amount. I'll give one other commentary about the IPO market. Lots of companies are going public. By the way, I think LinkedIn and Zynga are both preparing for various reasons to go public before the end of this year, to file, I should say, before the end of this year. I think that's going to be good news for anyone in the early stage market. Tends to lift the animal spirits. But I had a board meeting this past week, which was interesting to me in the sense that we have a competitor who I always thought was about maybe half our size. Once my company went public, one of the employees of the competitor and I were having a conversation, and he told me that based on what were our public financials, he could now say that they were as big as we were. And I said, well, wow, why didn't you go public? And he said, because our venture capitalists told us it would be crazy to think you could go public. And this happens again and again whenever I'm at entrepreneur sessions and VCs are on the panels. They always say you have to have 100 million in revenues, profitable for the last 3 years, yada, 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 and that's all bullshit. Wow. Because you can look at the companies that have gone public. About a third of them in the last 18 months have had sub 100 million revenues, and some have been closer to 50 million in revenues. Open Table being one of those. So I think in this market, as a venture capitalist, you have to be on top of things like month by month. If you believe that whatever it was, 2003, 4, and 5, when the rumor was you couldn't go public under 100 million, what'll happen is you'll miss out on an opportunity. These guys are particularly screwed, I think, because my company was the second company to go into the market in that market space. Being the third is really hard. Because what you usually do is you go out and you say, okay, the first guy to go out, he gets a lot of fanfare. The second guy goes out and says, here's where that big company is really missing something. And investors say, well, I'd prefer to have 2 plays in that space instead of 1, just in case something happens with that one company. By the time you get to the third one, it's harder to make the argument you want to own it. Lastly, on the venture capital side of things, lots of funds are going out raising money right now, and the hottest trend is what they call super angel funds. And some of you have read about that. This is really what it amounts to is smaller sized funds. And there's a sense among limited partners that a small fund is easier to return, you're a little more disciplined with your money, and you are going to be more careful about the types of deals you do and try hopefully to put money into deals that don't require a lot of capital. Here's one take on that view. And I do think smaller funds, call it sub $200 million funds, could be very profitable and good. But the idea that you're going to make all of your returns on M&A, I think, is not a good idea. And that's because, personally, my firm has taken a lot of companies public, and we've sold a lot of companies through M&A. And I think it's harder to have your company get sold than it is to take it public. Because once you decide to go and sell your company, you have to, if you want to have any kind of chance of getting a good price, you have to prepare a book, you have to go out, you have to talk to all what's usually your larger competitors and say, here's why you should buy us. And it's usually very disruptive. And after doing all that, the vast majority of companies never get acquired. Because at the end of the day, you're trying to convince one guy to buy your business. It's very, very difficult. It's actually a lot easier in some ways if you have the basic metrics to go and take your company public, even if that means a reverse merger. So right now, all of these super angel companies, super angel funds are saying, we're just going to invest $2 or $3 million, we're going to sell the company for $30 million. I mean, yeah, if you can do that, do it all day long, but it's really hard. And one of the reasons I think you're going to see a backlash against that in the next few years is that my own experience of buying and selling companies over the years has been, in order to buy a company and make it work in your portfolio, if you're a larger business, that company has to have some kind of culture. It has to have some kind of critical mass, right? Whether that be 100 employees, whether that be an established customer base, whatever it is. If you buy a company that's got 10 employees, it just came out with the first product, and there really isn't a culture there, the larger company generally kills it. And I think you see this again and again. Steve Jobs actually criticized Google this week. He's been doing that more and more. On one level, he was criticizing him for all of these, what he called junky acquisitions, where they buy the thing and they realize a few key engineers leave and there's nothing left. And that's a bigger and bigger problem. So yeah, it's great if you can get that done, but it's very hard to do. And at the end of the day, there is no alternative, I believe, to venture capital for certain types of companies. If you have an engineering-oriented business, if you have a company that's going to need $5, $10, $20 million of investment over 3 or 4 years, you're not going to get that anywhere else. You can't take that public. It's an idea, not a business. You can't get it funded through family and friends because it's too big of an investment. VC is the only area. And right now, the sector that I think is most interesting is not internet, but is actually communications and enterprise equipment companies, because those require the $40 to $50 million of investment. And as it happens, there's very little innovation going on in the big companies, which is why they're buying small companies if they can. And these businesses, take Riverbed for instance, WAN optimization company, never get funded a few years ago. It got funded like 5, 6 years ago. Right now, it probably be very hard to invest in or to have funded. That company has gone from $9 a share to $54 a share in the past 18 months, and I think it's because people realize there's no competitors being funded in this space for that sector. So with that, I'll leave it to Scott to talk about venture capital.